10. Common investing mistakes and how to avoid them. Hey everyone, welcome back to our channel. Investing can be a powerful tool for building wealth, but it is also fraught with pitfalls that can derail even the most well-intentioned strategies. Understanding common investing mistakes and knowing how to avoid them can significantly enhance your financial outcomes. Here's a look at 10 frequent missteps investors make, and practical advice on how to steer clear of them. 1. Failing to set clear investment goals. Without clear goals, it's difficult to determine the right investment strategy, and easy to be swayed by market fluctuations. How to avoid it? Define your investment objectives based on your financial situation, risk tolerance, and time horizon. Are you investing for retirement, a home purchase, or education costs? Setting precise goals helps in selecting suitable investment vehicles and maintaining focus. 2. Ignoring the importance of diversification. Many investors often put too much of their capital into a single stock, sector, or asset class, exposing themselves to unnecessary risk. This concentration can lead to volatile swings in portfolio value, especially if that particular market segment underperforms. Diversification not only helps mitigate this risk, but also provides the opportunity to participate in the growth of other sectors and asset classes that might be outperforming the rest. It is essential to remember that diversification is more than just owning different stocks. It involves varying your exposure across different types of investments, such as bonds, real estate, and international assets. By ensuring that your investments are spread across various sectors and financial instruments, you reduce the likelihood that a single economic event will significantly impact your overall financial health. How to avoid it? Spread your investments across different asset classes, stocks, bonds, real estate, etc., and within asset classes, various sectors, industries, geographies. Diversification can reduce risk and smoothen out your investment returns over time. 3. Overlooking fees and expenses. High fees can eat into your investment returns significantly, especially over long periods. How to avoid it? Always check the expense ratios of mutual funds and ETFs, and consider the cost-effectiveness of any investment product or service. Opt for low-cost index funds or ETFs where appropriate, and be wary of high-cost, actively managed funds unless they provide exceptional value. 4. Letting emotions drive investment decisions. Emotional investing, such as buying high out of greed or selling low out of fear, is a common pitfall. How to avoid it? Stick to your investment plan and rebalance your portfolio periodically, regardless of market conditions. Avoid making impulsive decisions based on short-term market movements and focus on long-term objectives. 5. Timing the market. Attempting to time the market is exceedingly difficult, even for professional investors, and can lead to significant opportunities being missed. How to avoid it? Rather than trying to time the market, consider a dollar-cost averaging strategy, where you invest a fixed amount of money at regular intervals. This strategy reduces the impact of volatility by spreading out your investment purchases. 6. Neglecting tax implications. Ignoring the tax consequences of investment decisions can lead to inefficient tax outcomes and reduced overall returns. When investments that produce high returns are heavily taxed, the net gain can be substantially diminished, highlighting the importance of considering after-tax returns in your investment strategy. Strategic use of tax loss harvesting can help offset the taxes due on capital gains by realizing losses in your portfolio at opportune times. Furthermore, the type of account you use for investing, be it taxable, tax-deferred, or tax-free, can also impact your overall tax burden and investment growth over time. By being proactive about tax planning and seeking advice from tax professionals, you can craft a portfolio that not only aims for high returns, but also manages tax liability effectively to maximize your wealth. How to avoid it? Be mindful of the tax implications of your investments. Utilize tax-advantaged accounts like IRAs and 401ks, and consider the tax efficiency of the investment vehicles you select. Consult with a tax advisor to optimize your investment strategy for tax purposes. 7. Chasing past performance. Investors often select stocks or funds based on past performance, a method that does not guarantee future results and can be misleading. How to avoid it? Focus on the fundamentals and future potential of your investments rather than past returns. Analyze current market conditions, the economic environment, and individual investment merits. 8. Underestimating risk. Some investors do not properly assess or understand the risks associated with certain investments, leading to unexpected losses. How to avoid it? Evaluate your risk tolerance accurately and ensure your investment portfolio aligns with it. Understand the risks involved in each investment, including potential loss of capital, and adjust your portfolio as needed to maintain a comfortable level of risk. 9. Failing to review and adjust portfolio. A common mistake is setting up an investment portfolio and then neglecting it, not accounting for changes in the market or personal circumstances. How to avoid it? Conduct regular portfolio reviews and rebalance as necessary to ensure it remains aligned with your strategic investment goals and risk tolerance. Life changes such as marriage, having children, or nearing retirement may necessitate adjustments to your investment approach. 10. Lacking patience. Investing is often a long-term endeavor, but impatience can lead to rash decisions, potentially sabotaging long-term growth. How to avoid it? Recognize that building wealth is a gradual process. Maintain a long-term perspective and resist the temptation to react to short-term market fluctuations. Investing wisely requires avoiding common mistakes that can undermine financial goals. By setting clear objectives, diversifying investments, minimizing costs, and making decisions based on solid research, rather than emotions or hunches, you can significantly improve your chances of success. Always remember that patience, persistence, and continued learning are your best allies in achieving your investment goals. If you found this video helpful, don't forget to like and subscribe for more exciting content. Thanks for watching, and until next time, keep chasing your dreams.